Hello and welcome to Forex.Academy, your #1 website for Forex and crypto education and analysis. In today's edition, we're going to be discussing Position Sizing Part 8, Optimal F Revisited, Why You Must Know It. Now that we know the properties of Optimal F, many of you may ask why bother with this theme. Optimal F is just a theoretical limit nobody would even approach. Well, that may be true or not. Nonetheless, information is power, and knowing the optimal F of our strategy or system is quite informative. To begin with, maybe unknowingly we are trading beyond the optimal point. The next graph shows several distributions, F-curves, with different percent winners and payoffs. These are attributed to different trading systems. In the graph, we can see that one of them shown in red is unprofitable, so the best position size is 0. The first profitable distribution shows its optimal F in the vicinity of 5%. That may indicate the system is poor, and a trader will be beyond its optimal F when several simultaneous trades are taken. By knowing the optimal F of the strategy we are using, we can assess its quality and figure if we have breached the optimal trading limit, risking too much. Optimal F will allow us to compare the real power of a trading system, measured by its geometric mean. The best attainable geometric mean will indicate which trading system to choose among a list of candidates. A safer way to compute optimal F. Ralph Fiennes defines optimal F as the divisor of the biggest loss, the result of which is divided by total cash to know how many pips or contracts to have in the next trade. But he assumes that the worst loss has already happened. It is much better for a trader to assume it has not happened. Due to the properties of the random processes, the statistical properties vary from sample to sample. There is no way to assess the real value, and that is true for all statistical distributions of trading systems. Monte Carlo resampling. With the use of computers and high-level programming languages such as Python, we have on our hands the possibility to create variations of the sequence of trades we took in real life. The use of Monte Carlo resampling will show a little more realistic picture of a trading system, signaling its limits and allowing us to be on the safe side. As an example, let's examine the performance of Forex.Academy's live signal service. The system showing the following basic stat parameters. Strategy statistical parameters. Number of trades 145, percentage of winners 67.59%, profit factor 2.41, reward ratio 1.16. The code to create several thousand different histories is simple. We use Python to speed up the process. Python translates Python into C. The gEthHistories function returns a container with the desired number of trade histories, and with the number of desired trade histories on each history. This function returns just wins and losses, not capital accumulation. Using a fixed trade size of 0.1 lots applied to 10,000 paths, resulting from the Monte Carlo resampling of the original path, on a hypothetical account starting with $5,000, we obtain the following graph representing about 1 year of trade activity. The smoke cloud seen is a typical resampling. In the figure we can see that some paths are luckier than others. The less lucky the path shows a final equity of about $19,200, while the most profitable goes over $29,000. This will result in different optimal F values. That happens because the laws of chance change the sequence's values, so every sequence will have its optimal fraction. We look for the lowest optimal F, which will minimize the risk of overtrading. Finding a safer optimal F. This procedure will also help us better assess the optimal F. That means we will compute all the optimal F of the resampling paths. As shown in the histogram below, we obtain a distribution of values that follows the normal distribution. We can then compute the mean, max, and min of the optimal collection, which in this case are as follows. What we look for with this procedure is to find out the minimum optimal F value, since we want to minimize the risk of overtrading. In this case, our minimum optimal F is 0.39, which is large enough to be in the safe side when using multiple positions. For computer geeks, this is the Python code to do the optimal F. Using these three functions, we can easily compute the optimal F values of a collection of trade sequences in just one line of code. The second line is just to plot this histogram. Here, rawhist is a container of the sequences, or history's optimum F is used to store the values obtained. Stay tuned for the next episode where we will explore more position sizing strategies. If you enjoyed the video, then please like and subscribe, and leave a comment down below about anything you would like us to discuss in future, or if you have any questions about this particular video. Have a great day.